Welcome back to the Brent Bruce Daily. Today is August the 23rd. It is 2:51 p.m. Central Time. If you have not subscribed to the YouTube channel, be aware that I just finished recording my long video that I've been talking about putting together, which is going to be talking about what is inflation, what has been causing inflation, and why we are in the inflationary position that we are now in over the past couple of years. I'm going to talk a little bit about what happened in 2008, how much money was spent on the TARP program that revived the banking system. We're going to talk a little bit about student loan debt. We're going to talk about wage-based inflation, inflation spiral, and how all of these things affect home loan interest rates and how you can learn more about how that works. I think it's about 49 minutes long. So make sure that you subscribe so that you're alerted when that comes out. Where are we right now? Let's take a look at the charts. Okay, so we're down 5 basis points today. That's pretty steady, really. You can see that we're right in this range here. And again, we recently know that after the Inflation Reduction Act was released on the 16th, which is right here, interest rates have gotten worse every single day since, because it is actually not inflation reduction, it is inflationary, which I talk about in the video. But you can see this new little Fibonacci level that was put in here. Now, I put that in myself, okay? So that is an imaginary Fibonacci level that I created myself. And the reason I did that is because you could see that there's a lot of this line being resistant, so it either being a floor of support or a ceiling of resistance quite a few times in the recent history. So I kind of like this Fibonacci level that I created, and I'm hoping that we're going to bounce off of it. You can see that we stopped at it yesterday. We kind of are banging around it here today, and hopefully we bounce off of this and we move back up closer to the 25-day moving average, and we start to test the 100-day moving average, or the 50-day moving average, which is here, as well as this Fibonacci level. Why would we do that? What's going to happen in the next couple of days that might help us? Well, two things. Personal consumption expenditure is a report that's going to be coming out this week, which is very similar to the CPI, the Consumer Price Index report. Both are measurements of inflation. So that we know that the CPI report came in at 8.5%, which was a little bit lower than the previous, which was 9.1. So inflation looked better. Now that we have another personal consumption expenditure coming out this week, I think it's coming out on Thursday. Maybe it's Wednesday. But anyhow, it was last at 6.8%. Now, if CPI was down, I guess we could probably assume that PCE is going to be down a little bit as well. Well, that would be good for the home loan interest rate world. Okay, so we should then, if things work out and the PCE is lower than 6.8%, we should see mortgage-backed securities bounce off of my new Brent Bruce daily Fibonacci level here and have it bounce up and test the 50-day moving average, Fibonacci level, and start trying to move back into this range. However, we also have something inflationary coming out, which is going to be the decision from the federal government as to what they're going to do with student loans, student loan forgiveness, and student loan continuing to defer those. Deferring student loans is inflationary, okay, because it's leaving more money in the pockets of people who have student loans. Now, if they were having to spend that money to pay those loans back, then they would have less money in their hands, which means they could spend less money on ancillary things. And that actually would reduce inflation. That's what the Federal Reserve is doing when they increase the federal funds rate. They're making people have higher debt costs and reducing people's spending money on other things. So if all of a sudden I have an extra $50 a month in my pocket that I don't have to pay towards student loan debt, maybe I go out and I spend it on restaurants, coffee shops, local pubs, IPAs, all the things that we love to spend our money on when we're in college. So possibly. And then also we have $10,000 here that they're talking about canceling. Now, if you get rid of $10,000 in debt, to me, I mean, honestly, I'm going to think like, sweet, and I got a little bit more money than I thought I used to have. I owe less money than I thought I was going to owe, which is going to make me feel more comfortable spending money on other things, which is inflationary. So where are our home loan interest rates as of this moment? Yesterday, we were talking about a 6.5%, if you recall. I'm sorry, a 5.5%. Strike that, 5.5% with no points. Where are we on the Brent Bruce Daily today? I'm going to say we're down 8 basis points now. Things are not looking good from an inflationary perspective in my eyes. I'm going to say home loan interest rates are now higher. We are currently at 5.5%. All right, staying flat. Remember I said this is fairly flat? Well, I guess it was correct. 5.5% with a $1,069 credit at 5.5%. Let's open this up. And I like to kind of look back at the 4.99. Currently, again, costing just under 1 point to get to 4.99. So we are definitely very similar to yesterday, because yesterday we were at 0.999. So actually we've gotten a little bit better in some way as far as the pricing on home loan interest rates on our 30-year fixed Brent Bruce Daily. Hope this helps. We have so much to go over. Please watch the full video to get more in-depth knowledge of the things that we talk about on a daily basis. Subscribe to the channel, please. Like, subscribe, and share, because this is information that really everyone should be privy to. Thanks a lot. Let me know your thoughts. Have a good day. Bye.